Welcome to another exciting and informative episode of the Entreprenudist Podcast, a place to hear real entrepreneurs and business owners bear it all. I am your host, Randolph Love III, and today is no different. I do have a very informative and knowledgeable business owner and entrepreneur on the podcast today. But before we bring them up, I want to remind you that this episode is brought to you by ShieldWolf Strongholds, a wealth growth and protection company. When it comes to estate planning, when it comes to retirement planning, when it comes to employee benefits, when it comes to life insurance, if your plan ain't ShieldWolf, your plan ain't strong. If you are a business owner that wants you and your employees to retire higher than you would have prior, make sure you visit ShieldWolfStrong.com or call or text +1 904 822 42. That's +1 904 822 4262. Now to our guests. Paul Musson has spent 30 years in the investment industry, with most of that time spent at McKinsey Investments, head of the Ivy Funds, managing $10 billion. That's billion with a B. In 2023, he left McKinsey Investments and formed his own investment consulting firm, Paddington Capital Management Inc. People can subscribe to his free weekly blog, Political Economy, founded in 2022, and that's political spelled PAULITICAL, at PaddingtonCapitalMGMT.com. The blog helps the average person understand what's going on in the economy. His book, Capital Offense: Why Some Benefit at Your Expense, was published in 2025 and explains in non-technical terms how our monetary system is leading us down a divisive path. I live, and when I say I mean he lives in Toronto area and has been married for 32 years, and they have 3 daughters. Welcome to the Entreprenudist Podcast, Paul.
Well, Randolph, thanks for having me.
Man, that was an exercise in reading. I had to change your first person to a third person on the spot, but I did pretty good right there to the end.
Nailed it.
Absolutely, man. You've been doing this for a while and at a high level. Is there nothing that you know now that you wish you knew when you first started?
Well, there's lots. When I first started, what? My own business or investing or?
Now, here we go. Paul's going to be an interesting guest, man. We going to get him. All right. All right. I just read your whole bio. You've been doing it for 32 years. When you first started, whatever it is there anything that you know now that you wish you knew when you first started?
Yeah. When I first started, a number of things, which is natural, right? There should be all kinds of things that you wish you knew then that you know now, because hopefully you've been learning over that time. Mm-hmm. And particularly in investing, it's a very humbling business. And particularly when you start out, you're younger, you think you know everything. You think you're a lot smarter than you really are. It's not that you're not smart. It's not that you're not working hard. You're just not as smart as you think you are. That's all. And so, you might take on a bit more risk than you should be because you're so certain about the outcome. And so what you do learn as an investor is that, you can't be so certain about the outcomes. And so you need to take a more balanced approach. Don't go all in. Make sure that your losses are not terminal. You need to be losing. You need to be making mistakes because that's how you learn. But, fail in small ways as you go. Mm-hmm. So that was a big lesson. I wish I knew that earlier on, but I learned it. I learned that the people around me are a lot smarter than I thought they were, which is sort of related to the first learning. And, and I wish I'd had more empathy for people when I was younger. And, I was very quick to judge. Someone would do something. Well, of course, it's because, they're a jerk or they're so whatever, I can't believe they did that. But over the years, particularly when you're raising a family, you start to have a better appreciation for the challenges that people may be going through in their lives on a daily basis. And maybe they're not in a mindset in certain situations where they're best able to handle certain things. And, maybe they just weren't their best that day. Doesn't make them bad people. But, so I think, so I was the one being a jerk back then, And I've just come to have a great deal of respect for people in general. That the average person is very smart. And most people, I believe, want to do the right thing. It feels good helping other people. It feels good seeing other people succeed and stuff like that. So, I guess those are the three things that sort of come to mind.
Oh, yeah. That's very wise and self-aware of you. Basically, knowing the more you know, the more you know, the more you don't know.
Yeah, exactly.
And I even had a conversation with somebody about that about a while back. Just imagine if I had the money to do what I thought was the right thing back when I thought I knew everything.
Yeah.
And then that empathy comes into play when don't judge somebody off the first meeting. They say, when growing up, they talk about the first impression always makes a first impression. You never get a second chance at a first impression. And yes, in a lot of instances, that's true, depending on the type of people you deal with. But when you encounter somebody as enlightened as you seem to be, it seems like you don't judge somebody off that first encounter.
I try not to. And it's impossible not to form some judgment. Right? Like your instincts take over. But I learned not to trust my instincts. I learned to sort of be aware of them and consider them, because sometimes you're right. But, verify, if you will. Do you know what I mean? Mm-hmm. And give people a second chance. And and it's not unlike why I wrote my book and why I do my blog. I believe that the monetary system is distorting things terribly, and which we can talk about, and it's serving to divide society. And bad, companies, like a bad corporate culture, bad systems, bad environments bring out the worst in very good people. We're all capable of our not finer moments. And particularly when you're in a bad situation, if you have a great corporate culture, if you have a fair system, that tends to bring out the best in very good people. So why not focus on having a system that brings out the best in people rather than the worst?
Absolutely. And it was another thing that you mentioned, that humbling experience. I know a lot of fighters, like professional fighters. And in my experience, the most dangerous ones are the most humble ones. And I always thought that because we'll go out and no action from them, and they're the last ones to want to get into a fight. And I always thought, just from my wrong understanding, was they're so cool is because they know they can beat everybody up. And then finally I started asking them individually, like, hold on, I know how dangerous you are. What's the reason you're so slow to react to things? And they said, because I've been humbled. I've been beat up. I know that no matter how big and bad I think I am, there's somebody else out there bigger and badder than myself. I just don't know it yet.
Yeah. No, that's very wise for sure.
And I can imagine managing $10 billion. You encounter a lot of personalities. What has managing that much money done as far as the people you met and how you choose to interact with people? Because I've already noticed something. A lot of the people that I know that are that got the B word in their bank account, they talk very slow and methodical. You have that methodical, slow way of talking. What are some things that you've learned managing this much money and the pressure and the stress, I'm assuming?
Yeah. So, and I don't think that I encountered a lot of stress in my career. I felt an enormous weight of responsibility, but I didn't find it stressful. It sounds like a contradiction, but let me see if I can explain. So what we would always remind ourselves of on our investment team, I had a great team, was that, why we are here and who is paying us. So our clients were financial advisors like stockbrokers and financial planners, like tremendous people, very smart, hardworking, and care about their clients. And a lot of my former clients are now on my blog and receive my free weekly blog, which is nice. And I hear from them from time to time. But always reminding ourselves that our goal when investing our clients' hard-earned capital was not to generate the strongest return that we could. If we could do that without risk, then we would do it. But that comes with risk. You risk losing a lot of it. And so we might look good for a few years generating supercharged returns and making, good bonuses. But if we lose half of it in year 4, then that doesn't help our clients. Our clients are relying on us to augment what they have already done. They have already had success, and they have created capital, and they have saved some of this capital for their retirement. We're here to augment that. First of all, protect it. Second of all, carefully grow it. And if we blow it, then we're going to have a serious negative impact on somebody's future financial well-being. And that is not going to feel very good. If I end up, when I retire, if I've blown up my clients and lost half their capital, that means all the bonuses that I took and all the money I earned over the years ended up coming at their expense rather than a mutual benefit. And a free market capitalist system, the way it's supposed to work is you only benefit to the extent that you're benefiting somebody else. It's a mutual benefit arrangement, and there's no coercion involved. Increasingly, we're getting into a benefit at the expense of somebody else. It's kind of like a massive game of poker. And nobody's breaking any rules, by the way. Same thing in poker. Nobody's breaking any rules. But everybody knows when they come to the table, there's no capital created at the table. Capital is redistributed at the table. And you have, at the end, you have one winner and a bunch of losers. Now, increasingly, that's what we're experiencing in the economy with growing wealth disparity. But I digress. So not a lot of stress. And I think that just came from making sure that we were really focused on, whose money it was, what we were trying to do, and very, very carefully managing the expectations of our clients so they know what to expect from us in different market environments. Nobody knows what the future holds. Markets or economy could do this, or any combination of the three. There are all kinds of opinions out there from very smart people who think they know what's going to happen, but they don't. Right? So we don't. So we make sure we tell people we don't know what's going to happen, and that's why we're managing your money carefully. And if markets do this, we'll benefit to some degree. If markets do this, we won't go down as much. You put it together, we're going to get you to your long-term financial goals. And then you can manage the money without stress. And it was the most amazing job, and met all kinds of very interesting people along the way on my team, very smart, great people. Financial advisors, amazing people, and the companies that we were investing in. We would go around the world meeting. Our style was to invest in high quality companies. And so by definition, you're meeting some of the best CEOs and chief financial officers in the world. And we would target companies that would manage their business like we would manage our clients' capital. They would manage their business knowing they don't know what the future holds. So they don't take on a whole pile of debt to buy back shares to drive the share price higher. They keep the balance sheet strong because they don't know, maybe we are going to have a serious recession. We'll need a strong balance sheet. And maybe we can go and buy some of our competitors who overstretched, who took on too much debt because they thought they knew what the economy was going to do. They thought it was going to be fine. Now they're in trouble. We can go buy the assets 50 cents on the dollar, whatever. And so just the whole thing was fantastic. It's great people, interesting people. Met a few crackpots along the way, of course, but that just makes life interesting, And so I was very lucky.
Oh yeah, that crackpot term, insincere, which comes from the word insincere. When the pot makers used to make clay pots, some of them came out physically sound, and some of them had cracks in it. And then they would have to put wax in those cracks and paint over it. And it looked just as good as the pots that came out the oven that were physically sound, but let one of those crack pots fall, it would shatter almost immediately, whereas the ones that came out sound, it was more sturdy, more stable, and more durable. And that's where that term crackpot came from. So when you're dealing with somebody that's insincere, the crackpots, as you call them, that's where you get, because they say you got two chances to make a first impression. First, when you walk in the room, and second, when you open your big mouth, right? Yes. So, and then that's how you figure it out. So yeah, definitely. When you go to those companies that have the same philosophy and align with you, it's easy to move forward to another level, because as fiduciaries, we're not supposed to treat people's money the way that we treat our money. We're actually supposed to treat their money better than the way that we would treat our money. And it sounds like that's what you do. Yeah. What is the difference between capital and money? Is there a difference?
Yes, there is. And thanks for that definition. I'd never heard that before on crackpot. Mm-hmm. But also reminded me of another saying, the second first impression is when you open your big mouth. Yeah. There's a line that says, better to keep your mouth shut and appear stupid than to open it and remove all doubt.
Yes. Mm-hmm.
So capital and money, they're different things. And the fact that a lot of people don't understand what the difference is what allows policymakers to extract a lot of people's capital from them. So capital is anything that people produce. Could be a good or a service. Your podcast, you're creating capital and it's being consumed by your listeners. Mm-hmm. They value what you're doing. So let's say you make a bike and I make a suit. We have both created capital, and then we decide to exchange that bike and a suit with each other. That's called direct exchange or barter. So now I've got your bike, you've got my suit. Now, importantly, this didn't come at anybody else's expense. This was a mutual beneficial situation where in the economy there was no bike or suit. You created a bike, I created a suit, we exchanged it with each other, and we're both happy. There's more capital in the world. But you can't have a large economy with direct exchange or barter. It gets too complicated very quickly. So instead of direct exchange, we have what's called indirect exchange. We do the exchange through money. So money is called the medium of exchange. That's all. So you will, instead of a direct exchange, you will sell your bike, let's say for $1,000. It's a nice bike. And now you'll use that $1,000 to buy the suit from me. It's a nice suit, right? So now here's where the trouble starts. Let's say you make 10 bikes. And so you sell them for $1,000 each. You got $10,000. You throw that in your bank account. What that money represents is the 10 bikes that you created. That money is temporarily storing the value of the 10 bikes of capital that you created, stored in your $10,000. Now, you don't spend it right away. You want to save it, go on a nice vacation at the end of the year. But before you get to go on your vacation, the central bank doubles the money supply. Now, when the central bank creates money, it doesn't first create capital to get that money. It creates the money out of thin air, just pushes a few buttons, right? So it's got no capital stored up in it. But that money obtains capital, it obtains purchasing power as soon as it comes into the economy by extracting capital from the rest of the money that's already out there. So as soon as that newly printed money comes into the economy, it takes 5 of the bikes from your $10,000 and puts it into new money. So now your bank statement still says that you've got $10,000 in your bank account, so you're feeling pretty good. But then when you go on to spend it on your vacation, you find that your $10,000 will only buy half as much as it would have done before, because now it's only storing 5 bikes instead of 10. That's where the value comes from. The value comes from the creation of capital. The money is very important. We couldn't have a functioning economy without it, but it's there just to exchange all the capital that we're producing. And when you increase the money supply, it reduces the amount of capital that's in your money. And that's one of the 3 ways the government gets your capital from you. The other 2 ways are, first of all, taxation. But with taxation, we can all vote. We can decide how much we want to be taxed to pay for police and infrastructure and welfare benefits, unemployment and Medicare, all in schools or whatever. So that's all like above board. We all say, no, that's too much or that's not enough. And we decide who we want in power to manage, take our money and give it to other people, right? Government doesn't produce any capital of its own. All the capital it spends, it first gets from the private sector. So taxation, they can borrow it. And then the third way is what I was just talking about earlier, when they print money. That's the hidden tax. And they take capital from society every time they print money. That we don't vote for. So it's a very pernicious sort of tax. And it's been going on for a long time. It got really bad during COVID. And it continues, and it will continue to get worse unless we fix our system, because the only way out, as you know, debt to GDP in the US is like 130% or something like that. I mean, it's crazy. You have like such huge fiscal deficits in an economy that's growing. This is not an emergency. And the only way that they're able to deal with this debt pile is what's called financial repression. So they will continue to increase the money supply and devalue any of your money holdings over time. And that's the only way they're going to be able to pay the debt, unless they decide to address the problem head on. But they'll only do that. Sorry, I'm getting ahead of myself here, but they will only do that if the people demand it. If the people demand that policymakers finally start doing the right thing, then they will start doing it, because that's what keeps them in power. It's not going to be easy, but policymakers are not bad people. Politicians are not bad people. they actually want to do the right thing. I believe that. And this is not a conspiracy theory, by the way. It's just really good intentions that went really bad, primarily by central banks starting around 2001. And so I'm trying to help people understand what's going on and sort of chart a path forward, if you will. But granted, it's not going to be easy.
Oh, yeah. I don't necessarily think politicians and policymakers are bad people. Maybe the people who have the blackmail dossier folders on them might be bad people, but maybe not them specifically. Is everything that you're saying connected somehow to the fake wealth effect or no?
Yeah, it is. I mean, look, there are all kinds of things that might be going on out there. And, I don't profess to be an expert on like geopolitics and social issues that are happening. That's not my area of expertise at all.
Pelican briefs.
Yeah, exactly. And so I don't think it's a conspiracy. I mean, it could be, but I just don't think it is. And it doesn't need to be a conspiracy for you to be angry about what's going on. So the fake wealth effect. Well, let me talk about the real wealth effect first. Mm-hmm. So real wealth effect, like we were talking earlier about when we were investing our clients' hard-earned capital. They had created capital and fairly exchanged it with others who created their capital, and they consumed some of it, and the rest they saved and they gave to us. And then we went around the world looking for the best utilizers of capital. Which company is going to put this capital to the most productive use to create more capital? So these companies create more capital, their profit goes up, they hire more people, they pay them more, they pay dividends. Our clients are making money because the share price of the company is being pushed up by the capital that company is creating. That's pushing the share price higher. So when you see stock markets going higher because companies are creating more capital, that's a real wealth effect. Real wealth is being created. The world is better off from a wealth perspective. That's a good wealth effect. However, central banks, they decided that they couldn't wait. This is all my opinion, by the way. They decided they couldn't wait for the lengthy and risky creation of capital process. They decided to instead drive stock markets higher first and hope that would drag the economy up with it. And so what they do is they take interest rates down to zero to drive the valuations higher. So the cap is not that there's more capital being created. The capital is being created doesn't really change, but what you have to pay for it does. It just becomes more expensive, but there's no more capital in the world, or no more than it otherwise would have been. And then they do it through quantitative easing, printing trillions of dollars to create what they call the wealth effect, or it's through the portfolio effect that eventually it drives stock markets higher. And they talk about this. They don't try to hide it. And they don't try to hide it because they thought it was actually good for the economy. Their intentions were good. But it's very short-sighted and self-serving in many ways, in my opinion. And so that's a fake wealth effect, right? Now, the really bad fake wealth effect is in housing. So around 2001, you had the dot-com boom in the 1990s. Everyone was making a fortune. There was a real wealth effect there. Portfolios are going up. They're spending more money. It was good for GDP. Then you had the dot-com crash. You had the negative wealth effect. People are feeling less wealthy, spending less, not good for the economy. So then you had some commentators like Paul Krugman from the New York Times, Paul McCulley from PIMCO. They were recommending that the Fed, instead of a wealth effect through the stock market, create a wealth effect through the housing market, drive housing markets higher because more people own homes than stocks. Then you'll get even more people spending their money. So after that very shallow recession in 2001, it wasn't even 2 consecutive quarters of negative growth. It was 1 quarter only. Very mild. They took interest rates down to 1%. Now that's the lowest it had been probably since World War II. These were like emergency levels for the Fed funds rate. And they kept it very low for 3 years. 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 And of course, mortgage rates went through the floor, which spurred demand for housing. And then you had that crazy housing bubble in the 2000s, which peaked, I think it was in 2006. And then all these ridiculous exotic mortgage type instruments, first interest only mortgages where you're not even paying any of your principal. Then they had negative amortization mortgages where you're not even paying the full principal amount on your monthly payment. So you got to have a 6% mortgage, but for the first 3 years, you're only paying 2%. The other 4% was added on top of your mortgage. But they said, well, don't worry. Once it resets to 6%, your price of your house will be up 30%. You just refinance and start all over again, right? So that worked until it didn't. And then you had, at one point, I think you had about a quarter of all mortgages in the U.S. were underwater. The house was worth less than the mortgage. And a lot of people lost their homes, and it was terrible. And so, you would have thought that given that these policies resulted in the worst financial crisis since the Great Depression of the 1930s, you would have thought that would have given them pause. Well, maybe we shouldn't interfere with mortgage rates and try and drive a wealth effect through housing. Maybe it wasn't a good idea. Instead, they doubled and tripled down. They bought trillions of dollars of mortgage-backed securities, treasuries, drove mortgage rates through the floor, and then did it again through COVID. And so a house has no business going up in price because a house is not a productive asset. So we live in the suburbs of Toronto, and we bought our house in 2001. And our house today is worth 4 times what we paid for it. Now, earlier, I was saying that, in a free market capitalist system, whatever wealth you have is supposed to be representative of the wealth you've created and somebody else has. Mutual benefit, mutual exchange. So when we make 4 times on our home, who out there in the economy somewhere is also 4 times better off? Nobody. In fact, it's even worse than that. They're 4 times worse off because if they want to buy our house, they got to pay 4 times what we paid for the same economic good. So our house is not a productive asset. It's not creating 4 times as much stuff as it did when we bought it in 2001. It hasn't expanded 4 times in size. It hasn't relocated to an oceanfront view that's 4 times nicer than where it is today. We just get 4 times on our home because I happen to be older. I'm 64. And I bought this house, or we bought the house, right when central banks started this fake wealth effect policy through housing. And it comes at the expense of the next generation, and it comes at the expense of newcomers or immigrants to our country. And it's not fair. Now, I haven't broken any rules. I played by all the rules. And I didn't even know this was happening, to be honest with you, until around 06, 05, 06, when I first started realizing, seeing what was going on, waking up, if you will. And the vast majority of people of my generation also didn't really understand what was going on. They just said, well, that's what you do. Housing prices always go up. So let's get on the housing ladder and then we'll all make a fortune. And so again, not bad people. And when I tell my generation this, at first they don't like it, right? It's a bit of a shock. And I explain, look, it's not your fault. And but your house wealth is coming at somebody else's expense. And so you think it's bad in the States. I mean, in Canada, the housing affordability crisis, it really is a crisis. And so many, I would argue most of the next generation can't even afford to dream of buying a house one day. The math just doesn't work. And so again, and even central bankers, they didn't intend to create a housing affordability crisis. They thought that by driving housing prices higher, all that spending would somehow spur this enormous amount of economic growth and prosperity, and that the benefits would all trickle down to everybody else. Well, didn't happen, and it's not going to happen. And even worse is that because people began to rely on the price of their house going up to fund their retirement, people started saving less than they would have done otherwise. So people consumed more. And so there was less saving and investment going on in the economy than there otherwise would have been. In economic terms, it's called time preference. If you consume more rather than save, that means you have a high time preference. You want to consume, satisfy things immediately. If you've got a low time preference, you're more willing to forego some consumption, save and invest your money, and consume more in the future because your savings are creating capital. And so the time preference of society increased such that there was less saving and investment than otherwise would have been. So there's no easy way out of this. There is a way out. It's not without pain. But I think the first step is really educating people with respect to how we got to this point, and stop trying to blame your neighbor or your fellow citizen. I think, like in America, like we have a place in Florida down in South Palm Beach. My mom and my daughter live down there. And so we go down there a lot. And in America, people are angry because this is my opinion, right? So they feel that the system's not working for them. They don't know why it's not working. And it's natural that you want to find someone to blame. And so then it's natural, again, that Democrats would then blame Republicans and Republicans would then blame Democrats. This is not a political issue. This transcends politics. And so we have a lot of friends down in Florida, Republicans and Democrats. They're all beautiful people. They can't talk to each other, and they would agree on 95% of things. You know what I mean? And so for me, this is really sad. And so I think just the understanding, the knowledge, and then the empathy that will come with that, will help to unite people, and let's move forward together and solve this problem. And I think we can do it.
Yeah, I know we can do it. And now you got to define we, right? So I heard you differentiate and distinguish centralized. So are you for decentralized?
Yeah, so I'm much more of a free market, decentralized. I don't like central planning. And doesn't mean I'm not anti-government at all. Government's very important. And rules are very important. Regulation is very important. But like anything, too many rules and too much regulation is really bad. And too much government is not good. Too much finance is not good. So, and I talk specifically about this in my book. My book, by the way, is, I'm sort of cutting corners here, but my book, I go step by step, very easy to understand terms. I use analogies so people will understand, so they're not intimidated. But I talk about in my book how government, very important. Finance industry, very important. But government and finance, for the most part, we are facilitators of the creation of wealth, of the creation of capital. We don't create any capital ourselves. And over the years, both government and finance have grown as a percentage of the economy. And so the facilitation is costing the real economy more and more each decade. And so there's less and less capital being put to productive use than there otherwise would have been. And you've seen productivity growth going down for decades. And so, and this is also a byproduct, if you will, of centralization, or if that's what you meant, central planning and stuff like that. So I don't want the central bank telling me how much I should pay for my house, or how much I should pay for stocks, or telling me, no, stocks aren't overvalued, go out there and buy them. I mean, they don't say that, but in effect they do. And that's very dangerous. The capital markets, the price discovery mechanism of capital markets is very, very important. You need capital markets to be unhampered. You can't have the central bank distorting interest rates lower than they should be just to drive asset prices higher, because then you get misallocation of capital. Capital is only allocated optimally when you have market players with skin in the game. No, I should clarify, with their own skin in the game, not somebody else's skin, right? But policymakers central banks, they'll play with skin in the game, but it's not theirs. It's everybody else's. And it's not a criticism. It's just a fact. It's just human nature. Unless it's your own capital, there's a tendency not to be as careful with it. And you have to remind yourself to be careful with it, just like we did when we were managing 10 billion of our clients' savings. Remind ourselves all the time, they're paying us. We can't afford to lose this. We got to be careful. And
Yeah, I know when I first started hearing the terms centralized and decentralized, and you think about it, and then it started saying it's a trustless system, and I'm like, that just don't sound right. Trustless, and what's happening is just to go back to your earlier point when bartering. I remember when I first saw people bartering, and it was on TV, right? I was watching old movies or old TV shows, and typically when somebody was bartering, it was usually very poor, like the characters were very poor characters, or they were homeless characters. And because they didn't have this money, they were forced to trade. And that's why, different people, what trade are you in, right? It really, just like you said, I got this skill set. I can do this for you. You got that skill set. You can do this for me. And growing up as a kid, I thought only poor people traded instead of exchanging money. But as I got older and as I started going to different levels of social economic levels, I saw that the higher I got, the more that bartering actually exists. And it was actually counterintuitive. The wealthiest people I knew wanted to trade. Oh, I know this person, or I do this. Let's do this, right? And then you connect that to the money. With what you're saying is, when even once it got to the money, if people were trading actual money, if I gave $100 to the bread maker, and then the bread maker gave $100 to the yeast and all of that to get all of their raw materials, without dealing with that centralized bank, that $100 stayed $100 throughout the entire process. But dealing with that centralized bank, taking 3% each go around, now all of a sudden that $100 is 97, and then now that $97 is 94, and then now that $94 is 91. That same 100 keeps getting lower, and you added some flesh and context. Because I heard somebody tell me, they said the cost of homes aren't going up. It's just the value of money is going down. And so, and I, even though it made general sense to me, the way you put it is, this house didn't move anywhere. It didn't go from being inland to beachfront. It didn't start producing it. I didn't turn it into a warehouse or a manufacturing plant overnight. This isn't producing any extra capital. Why is it worth more money? So it makes perfect sense the way you put it. Paul, is there a question that I did not ask you that I should have?
No, I think you asked some great questions, and I think it was a really good conversation. I mean, we could talk for days about this stuff. I mean, there's all kinds of things going on that need to be addressed. But people can reach out to me on my website, and my email is there, and happily answer any questions. I think that was really good.
Oh, yeah. And I know you said you come down to Florida often. Whenever you come down again, please let me know. I'm here in Jacksonville, Florida. And a lot of people don't know this. If you don't live in Florida, don't let the movies and the TV shows fool you. You might think that Miami is the wealthiest part of Florida. No. That Palm Beach is the wealthiest part of Florida, and that's where Paul visits on a regular basis. So Paul, I'm definitely going to stay in touch with you. So next time you visit, maybe you might invite me on one of your yachts. Hopefully, right? All right.
Don't have yachts, Randolph, but if I did, I would certainly invite you.
Hey, let's let the perceived value float. And for our audio listeners, please remind them your name, what you do, and how they can get in touch.
Yeah, thank you, Randolph. So my name is Paul Musson, and my company or my website is Paddington Capital MGMT.com. You can also get there politicaleconomy.com, and my book, Capital Offense: Why Some Benefit at Your Expense. You can get that on Amazon or Thrift Books or Barnes and Noble. And the Audible version just went live last week. So if people would prefer to listen, and I narrated it myself, which was not easy. It took some time. Thank God my daughter was helping me. And at my website, you can sign up, as you said, for my free blog. It usually goes out late on a Monday. And I'd be happy to hear from people.
And y'all hear how methodical Paul talks. So if you get that audio book, make sure you put it on 2-speed, right? So all right, man, this has been another exciting and informative episode of the Entreprenudist Podcast, the place to hear real entrepreneurs and business owners bear it all. I am your host, Randolph Love III. If you are listening to us, make sure you check out the show notes so you can get the links to visit Paul Musson, as well as also get the link to watch the video and watch our beautiful and immaculate ebony and ivory faces in your places. Until next time, don't play with it, stay with it until you make pay with it. This is the Entreprenudist Podcast, signing off.